Okay, thank you. Thank you very much for the opportunity to present. My paper is going to be on stock-specific price discovery from ETFs. So the research question here is, how are ETFs changing price discovery? An ETF is just an exchange-traded fund. It's a basket of stocks. So we could take stock A and take stock B and bundle them together in a basket, and investors are able to trade these baskets back and forth. These baskets will be arranged around a common theme. So there'll be some baskets around technology stocks, financial stocks, kind of an entire market basket. And if you want to say invest in the technology sector, ETFs provide a really easy way to do that. You can just buy a share of that technology ETF. You don't have to go and pick out which individual tech companies you'd want to buy. And this has proved incredibly popular. ETFs make up over 30% of stock trading volume. This is recent growth. Around 10 to 15 years ago, almost all trading volume came from people trading individual stocks like A and B. And now over 30% of volume comes from people trading these baskets, which bundle A and B together. Now, this has raised some concerns about the price discovery process. The thinking goes that ETF investors only care about the basket price. If you want to invest in tech stocks, you just buy that tech stock basket. You care about the basket price and not the individual prices. Now we have this equality that A plus B has to equal the price of the ETF. So if investors drive up the price of the ETF or drive the price of the ETF down, the individual companies, stock A and stock B, also have to go up or down. The concern is that stocks might just move based on what the ETF price is doing and not based on their fundamentals. So if people invest in the tech sector, it might give money to all tech companies instead of rewarding tech companies that are good and punishing companies that are bad. This is an important role of the stock market in providing price discovery. My paper is going to show that ETFs can actually contribute to stock-specific price discovery. I'm going to empirically document how investors trade stocks and ETFs in tandem. I theoretically model how this actually allows ETFs to enhance stock prices. I document how this behavior of trading both the stock and the ETF depends on the size and volatility of stocks. But I find that when investors are able to trade the stock and ETF in tandem, instead of getting this co-movement, the stock market continues to function. We continue to be able to price stock-specific information. So I conclude that the dangers of ETFs are attenuated. In this talk, I'm going to give a simple practical example of the ideas of my model. I'm going to summarize my empirical identification strategy. And finally, I'll just highlight the key results of my paper. So first, as a simple practical example, when and why do traders trade both the stock and an ETF? I have here a document showing the holdings of XLK, which is the technology sector ETF. Now, this is a value-weighted ETF. So if you invest $100 worth in XLK, you're getting about $20 worth of Apple. You're getting about $20 worth of Microsoft. For a medium company like PayPal, you're only getting about $2 worth of PayPal stock. And for Xerox, a really small tech company, you'd be getting 11 cents of Xerox. So this is what you're buying when you buy a share of that XLK basket. What I want you to imagine is that you're an investor who has an informational advantage in Microsoft. You know that Microsoft is going to do well. So what you'd like to do is buy Microsoft stock. Now, why would you maybe also want to buy XLK? Well, one of the big challenges in the stock market is being able to buy enough stock. Because once you buy a lot of stock, other people realize you might know something they don't, and they'll raise the price. So if you're just buying Microsoft, you're never going to be able to buy as much stock as you want before people start raising the price. So you could also do is go buy this technology sector basket, because it's 20% Microsoft stock. You could maximize your profit by buying both Microsoft and that basket that contains Microsoft stock. So the first key factor for when traders trade both is going to be size. It's going to work for big stocks like Apple or Microsoft. The second key factor for when traders trade both stocks and the ETF is going to be volatility. So I want to draw your attention now to PayPal. It may seem like a liminal case. It's just 2% of the technology ETF. But the volatility of stocks is not constant. If you think about a day when PayPal has really high volatility, say when PayPal announces its earnings, the volatility of PayPal could jump to 5 or 10 times that of the volatility of other stocks. And that means PayPal could start explaining a lot of the price of this technology stock basket, because even though PayPal is small, it could move around a lot. So it's not just big stocks for which this idea makes sense. It's also those medium stocks which are volatile. And that's exactly when we worry about stock price discovery, or that investors are going to be able to move prices. It's in these volatile cases. So now we have an idea for when traders should trade both. So the second thing I want to talk about is how I actually identify that traders trade both the stock and the ETF in tandem. So I'm going to be using stock data for this. And the big problem is that trade data is anonymous. It's a very closely guarded secret among investors as to what they're actually buying. So how could I actually identify that somebody trades the stock in the ETF if all the data is anonymous? Well, I'm going to exploit a key feature of stock data, which is that it's very detailed and precise. There's almost 30 gigabytes per day of data, every trade that happens, and these trades are timestamped to the microsecond. The idea I'm going to use is, what if investors traded both the stock and the ETF at the exact same time? So the idea is, if you think about why would people do this? Well, suppose they didn't buy it at the exact same time. Suppose people bought Microsoft, they waited a bit, and then went to buy XLK. What would happen is people would see that Microsoft had been bought, and they'd raise the price on XLK. So instead, what you do is you buy them both at the same time. That way, nobody has an opportunity to raise the price on either asset before you can manage to buy both. So this is a much better strategy than waiting. You want to buy them both at the exact same time. So the idea of my paper is, if I see a simultaneous stock ETF trade, I could actually identify this tandem trading behavior by investors. Now, for this to work, I'm going to have to be able to convince you that I can rule out that two trades are responding to each other. I'm going to have to rule out that these simultaneous trades are just due to chance. I'm going to have to rule out that these trades are due to hedging or arbitrage. So the first of these is the easiest to rule out. How can I convince you that trades are not simply responding to each other? This is my most technical slide, and I have here a diagram of what a stock exchange looks like. The key fact is that in this green box, the limit order book, that's where trades actually take place. For an order to actually get there and execute, it has to pass through this double blue arrow. This takes time. Whether you're a co-located high-frequency trading firm or just a regular investor, you have to pass that double blue arrow, and it takes at least 20 microseconds. So if I see a trade in, say, Microsoft and the technology ETF XLK, less than 20 microseconds apart, I can be confident that one of these trades is not responding to the other. So I can measure these simultaneous trades. On this slide, I can take a Microsoft trade that happens at 10:32 a.m., and I can check plus or minus 20 microseconds for a trade in XLK. Now, the next concern you might have is that I'm just going to pick up trades that happen at the same time due to chance. So what I'm going to do around each of these trades is I'm going to also estimate a kind of baseline level of chance trades that happen plus or minus 1,000 microseconds. There's a stark difference between these two regions. I'm going to show you here. On this graph, I'm showing whether trades happen where the ETF trades first, whether trades happen where the stock trades first, or right here at 0, whether the stock and the ETF trade at exactly the same time. And there's this very clear spike where investors are making this very deliberate effort to trade Microsoft and the technology ETF XLK at exactly the same time. So we know that they're happening at the same time. They're not responding to each other. So the third thing we have to do is rule out alternative stories. So suppose stock A is undervalued. My hypothesis, my story for why people would trade stock A and the ETF at the same time is that they want as much exposure to stock A as they can possibly get. So what they would do is they would buy stock A, but they would also buy the ETF, which contains stock A. Now, the big alternative story that I have to worry about is that what they're actually doing is arbitrage. Instead of an equality here, we could have an inequality where A is undervalued, so the price of stock A plus B is less than whatever the basket is trading at. In this alternative case, people would want to buy stock A and sell the ETF. So to rule out this story, I look at the trade signs. Do people buy both, or do they take a buy-sell position? So what I have on this graph are these simultaneous trades. And I look at the cases where someone bought the stock, and I say, did someone also buy the ETF? I want to be at 100%, buys with buys on the right. On the y-axis, I'm looking at if someone sold the stock, did they also sell the ETF? I want to be at 100%, sells with sells. As you can see, for my exactly simultaneous trades, all these trades take place in the upper right quadrant. People are buying Microsoft and the XLK at the same time, or they're selling Microsoft and this ETF at the exact same time. That works with my story, and it's inconsistent with arbitrage. So now I have this novel measure of when investors trade stocks and ETFs in tandem. What I'm going to do is go back and check whether it fits with my model. So if we think back to that pie chart, the two key factors of when people should trade both are when the stock is either large or volatile. So what I do is I run a regression analysis on a sample of 500 stocks over 3 years. What I find is that there are far more of these simultaneous stock ETF trades first in larger stocks. So if you think about Microsoft, that's going to have a lot more simultaneous trades than a stock like PayPal. But second, it also depends on the volatility of information. So in a day when Microsoft announced earnings, there are a lot more Microsoft ETF simultaneous trades. Or if Microsoft has a press release or other informational event, that's when people trade both the stock and the ETF. And that's when, as a result, ETFs can contribute to the discovery of price stock-specific information. So we know that the effect is there. And of course, the final question to ask is the effect big? So I find that around 1% to 2% of ETF trades are driven by stock-specific information. Now, to put that in perspective, we think that generally around 10% of trades total are informationally driven. So that means about 1 in 5 of these informational-driven trades in ETFs is actually driven by something stock-specific. And finally, I find that these simultaneous trades have a much higher than average impact. When people see a simultaneous trade, they really do learn about the single stock. So to conclude, I find that ETF investors trade stocks and ETFs in tandem. Now, this is important because ETFs become a huge part of the market. Over 30% of trading volume comes from these baskets. I should investors trade stocks and ETFs. They place these simultaneous same direction trades. They do this especially in large or volatile stocks. So as a result, I found that ETFs actually contribute to stock-specific price discovery. Our previous concerns over ETFs as a result are attenuated. Thank you.